Do you know how Warren Buffett doubled his wealth by investing small sums? Warren Buffett is the greatest investor of all time with a net worth of $99.4 billion US. And he is renowned around the investing landscape for his multi-dollar investments in companies like Apple and Bank of America. But contrary to popular belief, just like most of the beginner investors out there, he too had to start off small and then gradually turn those small investments into profits worth billions. It's not about that small sum of money you have in your pocket. It's about how you make the best of it that determines your financial well-being. In this video, we're going to unfold for you guys how Warren Buffett invested small sums in the stock market, which helped him achieve billionaire status by age 55. Sit back and pay attention because you can use this video as a guide for successful value investing in the stock market. One of the biggest misconceptions regarding stock market investing is that we need to look for some high-profile companies in order to make all of our profits, and we need to follow those elite investing analysts to find our profit-making stocks. Well, you'll have a different opinion by the time this video concludes. According to Warren Buffett, it is easier to generate great return rates when you're working with small sums. For example, Buffett noticed that in the entire US investing landscape, he only came across 6 people who were able to make $1 million at 50% growth rate when they were working with small sums. Now that means that it is quite difficult to achieve that much wealth accumulation, but it is also not impossible. It is interesting to note that Buffett also added that the same people weren't able to compound a $100 million or $1 billion at that same rate. This essentially tells us that it is far easier to get a good rate of return when you're working with small sums, but when you get to that $10 or $100 million rate, you're not going to get that same rate of returns. That literally tells us that, contrary to popular belief, small sums can pull off wonders for us. But why does this happen? For example, we need to take the volume of a stock into consideration. The volume of a stock means how many shares a company trades in a single day. Now let's say that there's stock which is worth about $2 per share and only 100,000 shares are being traded per day. When we multiply $2 with 100,000, it means that there are only $200,000 trading hands in that one given security. This also means that if you're going to throw $10 million in that security, it is going to take months for you to reach your full position. So the larger the sum, the more time it will take to accumulate wealth. Now, the question which arises is that how should we plan our investments with small sums of money? The answer to this rhetoric is quite simple. Find small securities in your own areas of competence. One of the biggest reasons why beginners fail to make big profits by investing in certain stocks is that they get trapped in mere speculations instead of doing their own research. According to Warren Buffett, before you decide to buy stocks, you should always know which stocks and companies you know the most about, and which business model is the most simple to understand for you. The logic for that is straightforward. You will never see a person with expertise in making hamburgers actually manufacturing cars. You should only operate in areas you know the best about. What you need is the ability to correctly evaluate businesses. Once you're in your circle of competence, the next thing you want to do is to find the occasional wrinkles in the market. Now, what do we mean by occasional wrinkles? Sometimes there are going to be some stocks which are underpriced by the market. You simply need to find a stock that the market is mispricing. Basically, this does happen from time to time. For example, let us suppose that due to some financial turmoil in the company, a certain company has its stock price way lower than usual. That is the moment you need to chip in to buy that stock because a wrinkle has been created. The next concept you need to understand before you start looking for these wrinkles is that of the intrinsic value and margin of safety. Now, intrinsic value is simply the calculated or the assumed value of the stock, and in case of finding an underpriced stock, you need to look for stocks below this intrinsic value. The margin of safety is simply the difference between the intrinsic price of a stock and that price at which you were buying the stock. You should always keep the margin of safety in mind before you go on a stock hunt. So always look for these wrinkles in the stock market which are selling way below their actual value, because after all, that is where you make your money. When working with a small sum of money, There are always going to be opportunities where you can earn high rates of returns. Now, there are some important reasons for this, and firstly, all those pundits and analysts do not pay attention to these small securities, simply because they can't invest their large sums of money in these securities. Understand the fact that the lesser the competition, the greater opportunities there are for you to make some serious profits. If people are not aware of these undervalued securities, you can have the bigger part of the cake for yourself. Also, there's not much media coverage around these small companies, and many people simply avoid these companies, terming them as speculative companies, making them low-key, which is going to be beneficial for you. So, to summarize, these large institutions can't invest their large sums of money due to the aforementioned reasons, and that is where you earn your money. Now, for example, Warren Buffett purchased a company, See's Candy, back in 1972 for $25 million. That's because Buffett spotted a major wrinkle in its price. And just after some years of productive sales, the company had risen 13 times to stand at an astonishing $383 million in 2007. He did not let the small market capitalization deter him from the big underlying profits he was actually looking at. When these small companies start growing into big companies, that is when they actually start attracting all that media coverage and hedge fund owners, ultimately making your investment quadruple in a short period of time. It goes without saying that small sums can help beginners get great profits in the long run, but most of the times, people are so preoccupied with media coverage, and some analysts who always seem to talk about those big companies, that we end up missing those crucial opportunities to invest in these small companies and making some profits. After all, it depends on how well you research on the stocks you're looking to buy, and for that purpose, it is extremely important to learn about the 6 stock categories that are each different to analyze. We've provided a free guide in the link given below, which explains these stock categories in detail, so feel free to make the best use of it. Check out this video we handpicked for you, and we'll see you in the next one.